So welcome everyone. Today's topic is how to get funding for your deals. So we have ways for you. Not only that, but today we have incredible people, panelists, helping us shining a light on the whole situation. And we're going to be focusing primarily on funding. So let's go ahead and introduce every single one of our panelists. So let's start with Nancy Villacorta from Chicago Funding. Go ahead, Nancy. If you can please introduce yourself.
Yes, of course. So welcome to the webinar. My name is Nancy Villacorta and I represent Chicago Funding. And who are we? So we are a broker that typically work with obtaining acquisition money, purchase and rehab money in the commercial lending side. And part of the lending partnerships that we're affiliated with are both commercial lending, what we consider soft money, lines of credit, and also hard money as well. So thank you for having me on the webinar today, Hugo.
Perfect. Thank you for joining, Nancy. And then Brandon, if you could please introduce yourself.
Yeah, sure. Thank you, Hugo, for putting this together. It's timely for sure, given these unprecedented times. Hope everybody's staying safe and enjoying the time here with their families. But that being said, my name is Brandon Moulton. I'm with Renovo Financial. We're a Chicago-based direct lender focused on residential investment projects, primarily in the bridge space from 9 to 18 months. And the assets we focus on are anything from single family fix and flips on up to 50 to 100 unit apartment buildings. And, you know, in those stages, we're typically getting it ready for sale or a bridge to refinance. So thank you.
Thank you, Brandon. Vince, welcome,
Hi.
Vince.
Can you hear me?
Yes, we
Great.
can see you and hear you well.
Perfect. My name is Vincent Pace. I'm from Becca Financial. We also focus on financing primarily 1 to 4 units, although we do a wide range of different transactions. We're a direct lender on most of our deals, but we will actually broker some deals as well. An example I always give in that regard is a church deal. We've had several of those come in and we've figured out what to do with them, so we try and help our clients. But by far, the most common sort of deals we're doing are the fix and flip type deals and also the long-term refinancings on rental properties.
Perfect. And then Juan Loya from Homebridge. Welcome, Juan.
Thank you for having me. It's better when I unmute myself, right? So I am Juan with Homebridge Financial. We are a residential mortgage lender. So we specialize in your agency loans, Fannie Mae, Freddie Mac, FHA. We also focus on the takeout loans. So when you get money to buy and fix it through some of our other panelists, then we step in and handle the long-term financing for those that are building rental portfolios. And we do have some products available for with the ability to get money to buy it and fix it. But there's going to be some additional guidelines that we follow that some of the other lenders are a little bit more flexible on.
Perfect. Thank you. Welcome, Juan. Okay, so having said that, we have incredible brain power online. So let's get started and get everyone's opinion of the panelists on what's happening today and how we can help new investors, seasoned investors. What are the changes that are happening and what is it that you can do to help new and seasoned investors today? So we can start with...
So who goes first?
Exactly. So ladies first. So let's go ahead and Nancy.
All right. So let's start off with what we do know. We do know that right now on the commercial side in commercial lending, many, if not all of the lenders right now are what we call in a holding pattern or offline. It's almost like the coronavirus. Give us another 2 weeks, give us another 2 weeks, right? So as of today's update, I'm hearing that April 30th is the next target date of understanding what these new parameters look like. Your question was, how do we help you to get started or get prepared. The number one thing that I keep telling a lot of investors, make sure you're liquid, make sure you have your reserves in place, make sure your credit is there, because even the standards are changing. We know that, we see that. Chase announced yesterday that borrowing mortgages now are going to require a 700 credit score and 20% down. It's no different than a lot of these other lending partners available for investors. So yes, we understand that it is a higher risk loan, but we also understand that these markets are challenging. They were looking at April default numbers. Now they're going to look at May default numbers. They need to know, what this means for investors, whether you're a new investor or a seasoned investor. So part of the tips that I tell people at this point, make sure your liquid reserves are in place, start saving your money. If you don't have it in place, partner up with other people that have a little more experience than you. And for sure, make sure your credit is in place, because when they start rolling this out, you need to be prepared.
Okay. Thank you, Nancy. Brandon.
Yeah, I think, Nancy hit the nail on the head. Stay liquid and be ready. But, for folks that have existing projects under contract, that are coming to me because of other lenders busting out or they can't close for whatever reason, I've got to really push back on those borrowers to make sure this is a good deal for them and why they want to do it. Given the environment, there's a lot of very smart money that it has hit the pause button, just in these unprecedented times to see where we're going to go, because your returns right now may not be adjusted for the risk you're taking on. So we're looking really hard at and focusing on combination of experience, LTV, and liquidity.
Liquidity. Perfect. Vince.
So, I can echo everything that's been said. The other thing I'll throw on top of that is the money you could get a month ago is not the money you're likely to get today, sort of no matter what level you are in the market. We were closing deals as low as 8-1 for some of our best clients. An average client would have been, low double digits and a couple points on there, something like that. Those have just been pushed up. The LTVs are down, the price is up. And I think anybody who's got something under contract pre-corona effectively needs to go look at that price, think about what the new cost of capital is going to be, and redo their numbers. You might want to walk. You might want to renegotiate the price down. Honestly, sellers, I don't know that they're going to have all that many options either. But we're advising pretty much every one of our clients who's come to us and said the deal doesn't work with these new numbers. Well, I'll say, go try and get the price negotiated down. And if it doesn't work, then it doesn't work. You got to go with your numbers, but there's options here beyond just throwing in the towel.
That makes sense. Perfect. Juan.
Well, I'm kind of on so I agree with everything that is being shared. I guess one of the big differences is that all of a sudden residential mortgages have now become relevant, more relevant than they were in the past. Again, the commercial lenders had a lot more flexibility than we did, prior to Corona, where, I had a lot of rules, but, better rates, and they had a lot more flexibility. In this particular case, my world still has a fair amount of liquidity. So the folks that we're trying to refinance in the commercial world, they're actually calling us quite a bit right now. And we're putting some of those deals together. Those that have, the qualifying credit and income and assets, we're able to help them on the residential side. But again, the reality is qualifying guidelines are getting tighter. But again, residential loans are, like I said, are relevant again for the investor. As Nancy and the other commercial lenders have mentioned, that liquidity is king, that cash is king, and now would be the time to potentially do a cash out refinance on your personal home or on some of your other assets, so that you can have that that funding available when the markets open up. Again, for us, interest rates continue to be at historically low levels. We're doing cash out refis for investors in the 4 and 5% range, which is a heck of a place to be. Owner occupied loans, we're in the middle to low threes. So it's again, great opportunity to get working capital out of your personal home. Great opportunity to reset some of your debt so that we're in a better position to qualify when things open up. And but again, unfortunately, not everybody's going to qualify in my world.
Okay, that makes sense. So nowadays, what we're recommending and what we're seeing is that people should be focusing on rentals, not flips, because flips are very risky at this point. Now, so for those investors who are interested in doing a rehab loan and then turn that loan into a rental loan, a long-term loan, what are your thoughts? What are your requirements? Go ahead.
Nancy.
Sorry, I had to unmute my mute button. So again, the requirements that we had probably 3-4 weeks ago are going to have changed, clearly. We don't have the new set and parameters in place. We're only speculating on the information that's being sent back to us at this point. It goes back to the same position, liquidity, reserves for sure. They are going to make changes in regards to what's the loan to values on purchase money and rehab money. And again, they're raising the rates and the standards for the credit score. So every lender is going to follow. Every lender has its own niche, of course, and
Right.
they're different product lines. But no one's really come out with the new parameters in place. They're just giving us the overview, the general overview, what to expect.
Okay, perfect. Because what I really like about Harmony lenders is that they give you the money up front to purchase the property, and also they give you the money for the rehab, which is great. But then you obviously need to refinance to pay them off and put the loan into a longer term. But nowadays, I see that many Harmony lenders are having both programs in place. They give you the rehab loan, plus they turn that into a rental loan.
So correct, Hugo. So just to piggyback a little bit, it's not just hard money. On any of the soft money and commercial lending in place, all the rental refinances are on hold as well during this pandemic. The two resources are, of course, the other portfolio lending that the community banks are doing, and the conforming, Fannie and Freddie traditional refis like Homebridge or any of other lending partners that we can refer to.
Perfect. Brandon, what's your...
Yeah, so we're focused right now primarily on bridge loans, but I know your question is directed to the takeouts. We had previously been offering and had great success closing 5, 7, 10, and 30-year fixed. About 2 weeks ago, 2 Fridays ago exactly, it was really saw the bond market and the securitization market tighten up. There's just not a lot of liquidity to buy those because they're packaged all up and then sold there. So we've hit the pause button on that piece right now, but we're just kind of waiting for Wall Street to respond and come back with that. So we are a direct lender on the bridge side, but to hold 30-year paper, that's sold off.
Okay.
But I've heard from a lot of my clients, that community banks still remain active. They're LTV conscious, but people are looking right now pretty hard for that single family rental loan. That seems to be a tough placement right now in particular.
Right. So now for those of our viewers who do not understand what a bridge loan is, can you please explain a little bit more what the bridge loan?
Yeah, absolutely. So the bridge loan typically is the all-encompassing kind of construction loan, whether it's private money, hard money, a bank loan, but it's for the duration of somewhere between 6 to 18 months typically. And it's the bridge to stabilization or exit.
Perfect. Awesome. Vince.
So on the rental side, it becomes much more prominent what the credit score is. When you're doing a flip, you just got to be sure that they can sell the property. You can relax on the credit score a little bit, but if the exit has to be a refi, then the credit score becomes all that more important. And the refi capital sources are definitely tightening up. The credit scores are higher. Debt service coverage ratios are higher. LTVs are lower. All the same things you're seeing elsewhere in the market, you're seeing there as well. Month ago, when we could have priced out long-term debt as low as the high threes, fours for the best clients, now we can't go lower than 5.5. And frankly, most loans are starting in the 7s and go up to the 8s for the long-term stuff. And on many properties, that might not even make sense depending on how much you're making off of it. We're still working on a large number of those deals. We found some outlets for it. Our normal routine of selling them, the same way Brandon does, no longer is working. But we found a number of places that are still active, and we've basically tried to help clients move over to there for the time being, if they can't otherwise bridge the gap until things normalize a little bit more.
There's a question for Vince. Are you seeing primarily 5-year balloons, or what's the offering there?
So strangely enough, all of the loans that seem to be active right now are 30-year. They're basically 5-year arms. So they're fixed for the 5, and then it's armed for 30 for the following 30 years. That's across the board for some reason. And I haven't put my finger on why exactly that is. I would expect to see more of the 5 years like you're talking about. But that's what we're seeing.
And are those traditional outlets, or what kind of?
No, they're all lenders that would be in the market normally. They've just tightened up their capital sources, or tightened up their terms, but they remain active. And that's how we ended up pushing our clients over to them, because we got stuck. We had a pipeline of them ready to sell off to our investors, but same thing happened to you, happened to us, roughly about the same time too, 2 weeks back. And that's when we started shifting efforts to help our clients get done what they needed to get done.
Got it.
Juan.
So, again, right, from the residential side of things, like I said, Fannie Mae really hasn't changed much of their underwriting guidelines in regards to the investor loans. The tightening up of credit scores, you're really kind of seeing that more on the owner occupied, but the investor, the Fannie Mae investor loans always required a higher credit score to begin with. So we really haven't seen too much change there at the time being. So we'll see what the future holds for that. But again, for the investors, strong credit is super important. One of and I don't know how this falls in with our other panelists, but we had a product which was geared towards investors. We called it our investor cash flow product. And right now, one of the big concerns that we're having is, we've got investors reaching out to us saying, hey, you know what, tell us about this forbearance. And one of the things is that the CARE Act, which is what the government has rolled out for this COVID crisis, and it includes mortgage forbearance, but that's only for agency loans, Fannie Mae, Freddie Mac, FHA. So our hedge fund loans, our investor cash flow loans are not covered in that forbearance program. So any of the investors who are requesting forbearances on these investor properties and investor loans, they're going to be in for a rude awakening, because their credit is going to get damaged. So I strongly have to recommend that people don't take that path of taking forbearances on their investment properties that are not agency owned. So again, only the ones that are agency owned fall into that CARE Act, from my understanding, what do you guys know from the other commercial side of things?
Great question. Nancy?
So,
Brandon Bean?
to piggyback what just Juan said, I'm so glad you brought that up, Juan. Kudos to you, because exactly what you said, a lot of the investors are trying to play it safe and saying, hey, well, if my renters are not paying rent, well, then I should get a break of paying my mortgage. And they don't necessarily understand the difference with what we call a deferment and a forbearance, because at the end of the day, the forbearance, they're going to ask to pay it up all front or pay it off at the end of their forbearance period. But I do have a question for you, Juan, since we're talking about the subject. You said a lot of your changes, a lot of changes are not happening. They're pretty much the same with your Fannie product on the conforming end for the refinance. But are they going to make any, do you know of them making any changes on the, on seasoning for title? Is that going to remain on the 6 months?
Right. So those rules were already in place prior to this whole crisis, right? So that's not really changing. So Fannie Mae still requires a 6-month seasoning for cash out transactions, but they do allow a rate and term without any seasoning. So, for the investors who were using private money to buy it and fix it, or who were, working with again, with the commercial side of things, if they were financing the acquisition rehab, we can do the takeout loan right away for their current balance. If they're trying on the rate and term, if they want to get, up to 75% of after repair value, then we have to wait for the 180 days in order to do so.
And with what credit score requirement?
So right now, so Fannie Mae hasn't necessarily changed their credit score requirements. The individual lenders are starting to change their requirements. So somebody mentioned that, hey, now Chase is requiring 700, 20% down with a 700 credit score. That's a Chase overlay, right? So Fannie Mae hasn't actually changed their guidelines. It's the lenders who are becoming more conservative. So at Homebridge, all I can really do is speak to Homebridge. Homebridge will continue to offer a 75% cash out refinance on an investment property with a 680 credit score.
Thank you, Juan.
Right.
Can I answer that question, if you don't mind? So in underwriting our deals, we're looking at, especially on the flip side, we're looking at that FHA line in each market has a good guideline as to safer and less safe, right? If it's under the FHA number in the particular market, we like that better, because the assumption on our end is that that's going to allow them to have access to a broader range of capital, make our clients exit easier. In other words, there's lots of buyers who can buy their product or buy their property with an FHA loan, and that makes it easier for them to sell into a market. Are you seeing the kind of restrictions that Chase put on affecting the FHA level, and do you expect them to become more widespread?
So currently, every lender is reacting. Every lender is reacting differently. Okay, so the answer, I'll tell you that the answer to that, from what I'm seeing, is absolutely there's a tightening. Okay, I'll go into a couple of reasons why. Prior to the coronavirus, we were lending, we were doing FHA loans all the way down to a 550 credit score. Okay, 550 was really, again, that was a real stretch, if you would. Okay, but we were going to a 580 credit score with no additional down payment requirements. We would go to 550, but it was 10% down instead of 3.5. But we would go to a 580 with natural FHA guidelines. Okay. There was some limitations in terms of what ratios we would allow to go to 580, but now our organization, Homebridge, is now requiring a 640 credit score for all FHA loans. Right. Now it's 3.5% down, but minimum 640 credit scores. Other lenders, again, very large common lenders are 660, 680, 700, even for FHA. One of the big challenges that lenders are having, all of the challenges is that we're all seeing has to do with liquidity in the marketplace, right? You guys can't write loans if nobody's willing to buy them. It's very difficult to write these loans. So the challenge with the government loans, with FHA loans, is the lenders, the servicers, when they have FHA loans, FHA is really a guarantee. It's a federally guaranteed loan. Now, the government does not put up the money for the loan, but they guarantee that if the borrower were to default, we as the lender get paid back, right? So it's really an insurance policy. What happens with the FHA loans, for instance, is we give a loan, if the borrowers do not make their payments. So first of all, anybody who bought a house, let's just say they purchased the property in February, end of February, beginning of March. If their first payment was April 1st and they requested a forbearance, which is allowed by the law, right? That's a first payment default. That's a non-saleable loan to FHA. By the rules of the program, that is no longer an FHA insured loan. That's a bust out. And bottom line, the lender now owns that, a couple $100,000. What's a couple $100,000 between friends, right? We own that loan now. We cannot deliver it to FHA. Okay, fine. We put that loan on the shelf. We're going to service that. We can survive that. No problem. We can do a certain number of loans that way. But what happens with the government loans is when the borrowers take a forbearance or when they default on that loan, it is the servicer's responsibility to pay. We basically have to pay the investor their monthly payments all the way until we basically file the claim for the FHA insurance. So all of these servicers who are holding hundreds and thousands of mortgages, what happens when 10 or 15 or 20% of your portfolio doesn't pay and you have to carry those loans all the way through the time of the guarantee? That's catastrophic, right? Mm-hmm. And the reason that you're seeing this tightening is because the lenders are the lenders are afraid for their own viability, because if we have to continue to make payments to the asset holders, that'll bankrupt many or most lending institutions. That's why you're seeing lenders go from, well, we're not going to take the 580 risk, but we'll go to a 640, 660, 680. That's why you see the pullback. It's not because FHA has changed their guidelines. It's that the lending institutions are being dramatically affected by the end result. Does that make sense?
Yeah, so it sounds like the bottom line for our flip clients and for us when looking at these underwriters is that the FHA number is still a safer number to be aiming for in terms of your end user's loan. But even that's more restricted now than it was before. So maybe you're at 2/3 of the buyers you might have had who could have gotten a loan before, or something like that. There's just some number out there that it's reduced by.
Yeah, absolutely.
That's great feedback. There was a product you were talking about before that was up to 75% LTV with sounded like rates kind of where they were at pre-COVID. Is that an LLC, or is that held in your name personally?
No, right. So that's a standard Fannie Mae loan product, and basically that is in your personal name. It cannot be. It is not in an LLC. It's in your personal name, and we can allow up to 75% of the after repair value. So we can do rate and term during the first 180 days. And if you, so basically whatever you currently owe is what we can refinance for the first 6 months. after 6 months, we can recognize the new market value, the after repair value, and we can go up to 75% of that. Now, Fannie Mae continues to have a property limit. This has not changed, is that Fannie Mae will only allow somebody to have up to 10 mortgaged properties in their name. So there's a limitation as to how many properties, one person, not how many they can own, but how many mortgage properties they have.
Sure.
Right. So that's kind of so some of the institutional, some of the seasoned cash flow investors who might already have 10, 15, 20 properties, Fannie Mae is not going to be an option for them because they're already maxed out.
Some of the feedback that we're hearing, if and when, I should say, these new parameters that come back on the commercial side where people, are interested in keeping these mortgages under their corporations, under their LLCs, but even within these new parameters that we're expecting to hear back any day now, if in fact it will take place after April 30th, it's going to be much more challenging for new investors that don't have at least 4 or 5 transactions as a baseline. Because again, the higher the risk, it goes back to, they understand that investors are not going to be able to pay these mortgages if renters are not going to be able to pay their rent.
Yeah.
Right. The part of it is a lack of experience, and and again, part of it is also that it becomes, when the market's going up, everybody's a genius, right? Anybody can pick a good stock when the market is going up. When everything is good and the money is flowing and everybody's out buying these properties and building cash flow, and all of that's well and fine and fun, and we can all laugh about it. But then all of a sudden this hits, and many people called me up and said, well, what am I going to do? I own, 5 properties and nobody's paying me. I said, well, you've got to cover this. You're the investor. You're the one that you have to measure your limitations and make sure that you're covering the debt that you're taking on. So that's critical. And I think that if any investor takes it lightly and goes into that forbearance, I think it will affect their ability to grow once we get through this, what I believe is going to be a very short-lived crisis.
And what is your biggest fear for newbies and for seasoned investors? And what's your advice to both of them? How can they overcome the fear that you guys have?
Was that to me? I'm sorry.
To everyone, what's the biggest fear that you have right now for newbies and for seasoned investors? And what is it that you would recommend for them to sort of prepare or overcome that fear?
You want to go ahead, Nancy, just keep the same order, or you want me to go?
Go ahead.
Okay. For new investors, I think the biggest fear is, just are they buying the right deal that makes sense for them? Are they asking the questions they should be that they probably just don't know yet? So, my advice to them is really just move very slow and cautiously, because whatever deal you think you have may not be the right deal right now, but there will always be a deal in the future. Don't feel like you're missing out, because there really may be an opportunity in the next 180 days or so to find some really good deals and cherry pick there. For seasoned investors, I don't know. It's kind of hard to teach an old dog new tricks. But, from that perspective, I mean, I don't know if I have any fears for people that have been in the game for 20 plus years. They've kind of seen it all. I'll tell you this, though, to kind of Juan's point, like if you have a 4-1 payment, Yes, you'll have empathy from us that, yeah, this sucks to be a landlord, but and maybe rent collection is tough, but you're not going to get any sympathy from us in the sense that there's no reason or no excuse that you should miss your 401 payment. That will not look good, and that will hinder your ability to borrow if you let it snowball, going forward, because you just don't want to be that guy right now. You want to get tough now because it could get harder. But if you start missing payments this early in the game, it's just it'll run on you. That's it.
So as we were talking about what we fear, pretty strong word, but this is the conversations that we're having day to day with all the investors, no matter what level of experience. Liquidity is everything. Reserves are everything. Cash is king. Do we think that other opportunities are come in play? For sure. I mean, it's happened in every other, recessions, and look at what happened in 2008, but definitely this pandemic and this crisis is different because it's not just, it's not just economic. It's, it is housing and economic combined, correct? But what we are telling people is, just make sure you keep your score, make sure you protect your score, do everything you can to make sure these payments come in, do everything you can to make sure that the reserves are in place. And if you're unable to get any, you may not have as open doors as you did, a few months ago or a few weeks ago. But this is a time where new investors may have to partner up with seasoned investors to try to get their foot into the game. So that's not necessarily a fear. I think it's just being practical, and the risks, they have to be very, very cautious. It's not the same level of risk as before, for sure.
So somebody just posted, what do we got? What do we think is gonna? How much do you think of a drop you guys are seeing in the market? And what does a good deal look like in current market conditions? And I do want to come back to that in a second. So, one of the in terms of the fear that Hugo was mentioning is, I think the biggest thing that I would say is don't chase deals. Don't try to force a deal just because you think you have to put one together. If you can just let the dust settle a little bit, I think there's going to be some great opportunities that are going to pop up. Now, personally, what the belief that I'm accepting. There's a lot of opinions out there, but the belief that I'm accepting is that we're really not going to see a major decline in property values. Prior to COVID-19, if we rewind it, a month or 2 months ago, everything was firing on all cylinders. The market was, basically 13-year highs for housing starts. The economy was moving great. Housing was doing very, very well. Lending had, obviously lending has been much more conservative over the last decade than it was, prior to 2010, where, anybody with a heartbeat could get a loan. So, again, there's been a much more conservative approach to residential lending, to the owner-occupied side of the world, right? Commercial lending had freed up some, but residential lending was tight. And really, again, housing starts were at a 13-year high, and what's driving housing starts was really household formations. And what's driving household formations goes back to basically the birth rates in the 1980s were super high, super strong. And now you're seeing all of the people who were basically born in the 80s, they're coming of age, and, they're starting their own families, and there is a need for additional housing. So as long as that's driving the market, although this is going to have a big, obviously huge economic impact, we're not expecting to see the big drop in housing prices that we saw in again 2008, 9, and 10, simply because the rest of the economy was the rest of the economy prior to COVID-19 was working very well. That's what many of the people in the mortgage industry, a lot of the economists are believing that this is going to come back very quickly. So we're not going to see a huge decline in housing prices. Now, with that said, does that mean there's not going to be great opportunities? I disagree with that. I think there's going to be a lot of great opportunities, because remember that people who were already in trouble prior to this crisis, people who were behind on payments, people who were already noticed a default or in the pre-foreclosure stages, well, this will totally knock them out of the game. So there's going to be a lot of inventory that again, people who were still trying to save their home, they're going to get knocked out. So those properties will be coming to market at some point, and I think that's where the savvy investor is going to be able to pick up some good opportunities, not because the housing crisis dropped property values, but simply because there's some people who were already on the bubble. They were already weak. This is just going to put them over the top.
To go back to Hugo's question, and then I'll actually go back to Farhan's as well. For the newest investors, I want to echo something that Nancy said, which we've actually seen work out with a couple of our clients, which is partnering up with someone more experienced. We actually had one client bring us a deal that was a good deal, but they just didn't have the experience to really qualify to get it done. We introduced them to another of our clients, and they partnered up and are actually working through the project now. I've got the first draw coming in, first draw request just in today. So they're making good progress despite everything that's going on around us. So there's a lot of value to partnering if you can do it. If you're not going to partner, I think my advice to new investors would be to price out the capital first. The capital is not as cheap as it might have been when you were taking a mastery course, or whatever you originally did to figure out sort of your numbers. So you might want to pin that down, because especially for new investors, the prices have increased, sort of the highest I've seen in a long time. My experienced clients, one thing I've seen a pattern among them. Yeah,
Vince, sorry to cut you off. Do you mind sharing that range?
Sharing what?
Like the range of how quickly or how much capital has spiked? Because I'm just curious, because you talk to a lot more capital sources, but candidly, our pricing has gone up, but it's like falling on deaf ears just because I don't think clients have heard it from enough people yet.
Yeah, and I don't think sellers have either. Sellers don't realize that their numbers aren't going to work, but that's sort of a sidebar. So what we've been seeing on the range has been, the best clients we're seeing are getting like 10s and 2s, 10s and 3s, something like that. Whereas previously they could have gotten 8 and 1 or even better in some cases. For the newer clients, I mean, we're seeing rates, as high as the mid to even high teens. With points, the highest point deal I've seen this month was 10 points. And that was a hairy deal with a lot of stuff going on in the background, and there was a reason it got that high. But for, your average newer investor who doesn't have a lot of experience, 5-6 points is not unheard of at this point in the COVID-19 crisis. For more experienced investors, one thing we've been seeing a pattern among ours, so it's less advice than me just sort of reflecting back to you all what we've been seeing from them, is that they've been chasing opportunities. Some of them had things under contract pre-COVID. They went back. I've seen one negotiate a price down almost 40%. Apparently the seller was more panicked than they were about the whole situation. They were willing to take that because they said, hey, I need my cash now. I can't wait 2 months or whatever it's going to be until this is all over the worst. So we've been seeing our experienced investors really go after some of those deals. To speak about the expected drop in the market, one of the things we did when we set up our underwriting guidelines was we looked at the Case-Shiller data. And if you've never heard of that, it's this big data source where they get all this real estate information and they just compile it into one place, and you can access it and you can analyze it. We looked back at the 2007-8 crisis, and we saw that in most of the country, and in particular in the Chicago area, in a single year, nothing dropped more than 10%, pretty much in any asset class. There are a few exceptions. Miami condos, some of the exurbs of Las Vegas are examples. But for the most part, you take any asset class, any geography, there was never more than a 10% decline in 1 year. Now, over multiple years, you did get much bigger drops. But in a single year, which is typically the time of a flip, that was sort of the number that was effectively a cap. We're sort of working on the assumption that we'll see something similar here, and we've been listening to things that have been coming out by people smarter than us about this kind of stuff. And we are typically seeing numbers from 4 to 10% range in terms of where they expect the market to drop. If I were to place my money, I'd probably put it closer to the lower end of that, 5-ish. That's based on reading all the different things I've seen. So that's sort of what we're expecting to see in terms of the price change, if there is any, within a short-term time frame. And so in terms of, determining a good deal, I'd say make sure you get your capital pinned down, but also make sure you're building in this kind of sort of ARV drop. So, reduce it by 5%. Does the deal still work for you? Are you still happy enough to do the deal? Those are the kind of things that I would look at if I were looking at acquiring a flip property right now.
Great. So, Brandon, you mentioned earlier like a great deal, right? So look for great deals. What is exactly that you're looking for the investor to have in place as far as LTV, down payment, experience, FICO, liquidity? What are the components, the magic formula for them to get funding?
Wow, that's a loaded one. It changes by the day. I say that jokingly, but not really. You can see the stock market's up and down. Investor confidence comes and goes. There have been surprisingly a wave of payoffs, but I think those are all stemming from, the properties that were under contract. So there may be some false hope, or maybe it's reality, but getting to a closing table is kind of hard in itself right now. But getting off a little off topic, but from a borrower standpoint, we're looking for folks that have a focused business plan. That's first and foremost. I've had so many conversations with people that say, I just go where the money is, where the best deals are, and you run into them at an event and a couple of years later, and they've still never done a deal because they're not focused or whatever. So focused business plan, well capitalized. On the multifamily side, you can see Fannie and Freddie have come out and said they want anywhere from 6 to 18 months of interest reserve. Now, that's a little strong for the business that we're in. But that gives you a sense of what kind of capital requirements people are looking for. In terms of down payment, I would say the days of 10% are out the window right now and on hold. 15% for the best borrowers, 20% for, and escalating for, the average, and, newbies even higher, maybe, I don't know. LTV, 65 would be as high as, we'd entertain at this time. 60% would be kind of the average that we'd be looking for. Credit score is going to weigh heavier, even on the bridge side, because we're gonna look at it as a flip, and also probably as as even a rental on both sides in all instances, to see how we can get out of this. And FICO weighs heavily in that, so 660 and above is definitely preferred. Outside income, that is not dependent heavily on real estate flips, is going to definitely weigh heavily. So W-2. And you're going to have a lot of questions about what is going on with your unemployment or your employment at this time, how the company, your day job's doing, and also the health of your real estate portfolio would definitely be a hot topic in terms of collections. So yeah, it's a combination of all those factors, and antennas are definitely up. But ultimately, I think all of us lenders on this panel can confidently say, like, we don't want to put anybody in a bad deal, so we're going to ask all these questions in detail up front to get through this, because I think we've all mentioned this. I think the real deals are on the other side of this. So if we can kind of get through it, we can really have some fun on the other side of it.
Do you have anything to add on that answer, Vince, Nancy, Juan?
I mean, I can largely echo much of what he said. I mean, if I were targeting a deal myself, I'd probably try and be in the 60 to 65 range for sure. That's definitely going to maximize your ability to get funding. We've got some options to go higher than that, but you're really going to need to be, the cream of the crop investor with a lot of experience. Otherwise, 60 to 65 is probably your target range. But other than that, he pretty much, said the same. Pretty much everything he said is the same way we're looking at it too.
So again, from the agency, from Fannie Mae's perspective, we still have some great products that hasn't gone away. But again, it's a different spirit of what Fannie Mae is really designed for more of the mom and pop investor versus the institutional investor. Again, the limitation on number of mortgage properties. Currently, we haven't seen a change in their guidelines for what we call the home style renovation. So Fannie Mae still has a product. It's 15% down of acquisition and rehab for investors, but that is going to be limited to single family residents, and it's going to be limited to one project at a time. So very much a mom and pop flavor, right? It's not for the movers and shakers who are trying to run 10 projects. That's not really where that comes into play. Now, the other thing about Fannie Mae is, Fannie Mae is designed to be a long-term loan. It's a 30-year fix, and it's intended to be a long-term loan. It's not really designed for your fix and flip type project. So if we have an investor who ultimately says, look, I'm looking to buy this, fix it, and sell it quickly, then we can't really use that Fannie Mae product, because we're going to all that would happen is we end up losing it in the long run. So that could be a good option for somebody who wants to buy it, fix it, and keep it as a long-term rental. But keep in mind, you have 15% in the deal. Then you wait 6 months. We do a rate and term refi, or we can do a cash out refi at the time. But it's going to, like I said, for the mom and pop, the newbie investor, that's a great product. But it's going to, like I said, it's going to be one loan at a time, and it's designed to have training wheels, and we're going to make sure that the entire deal makes sense. So it's a more conservative approach than the commercial side, but it still gives an outlet for kind of the newer investor who wants to take advantage of this market.
Is there anything that we have not covered yet that is important for our investors to know, newbie seasoned investors, that we should?
I think we've hit it pretty hard. I mean, you gotta buy with discipline, take your time, make sure that the deal makes sense from a bunch of different directions. The cost of borrowing is higher. The challenges to borrowing is higher. But again, there's going to be some great deals out there, Hugo. But everybody's got to keep a calm head, and if we can keep a calm head and look for those great deals, I think we'll all do well. And by the way, the one thing that hasn't been mentioned here, all of where this is taking us, bottom line is the DealVault becomes that much more relevant to be able to go identify those great deals. And if the cost of capital is higher, that just means we got to find better deals.
Absolutely. Yeah, no, thank you, Juan. Now, are there any questions on the line that the panelists can
I would
answer?
add this for sure as a new investor. Any contracting relationships you have or are developing, make sure you thoroughly vet and keep a strict and maintain a strict payment policy with them, because in this type of environment, who knows, you know, if their money is if they're going to rob Peter to pay Paul, all those types of things. Classic contractor fiasco. You do not want to find yourself in. So just make sure you're vetting those folks very, very closely.
Great. Anything to add, Vince?
I mean, what Brandon said is absolutely on point. We've, I'd say most of the defaults we've had to deal with have been because of contractor issues, not for other issues for the most part. We've had maybe a handful of medical issues where they had to divert funds elsewhere, but for the most part, it's really been those contractor issues. So that is unfortunately not specifically COVID-19 advice. That's universal advice, but it goes just as much now as it would at any other time.
Great. No, that makes sense. So can all of you share your contact information in the chat so that our members can reach out to you in case they have further questions?
Sure.
Perfect. And then everyone will be able to see your contact information. Would there be anything that you would like to add to the panelists?
I think
Well, I
that
would,
we all
go ahead,
stand.
Nancy.
Sorry, Juan. I think we all stand in agreement, and I like what Juan said earlier. These are challenging times, but we do think that the dust will settle, and it's just a matter of time. I tell everybody, let's just keep connected. You know, what was here today, you know, is a holding pattern, and hopefully this will free up, and this will start, you know, becoming a standard for sure on what products are available for our investors. But let's just keep connected. I mean, hopefully, you know, we may have a product that, you know, that other lenders don't have. Other lenders may have products that we don't have, but we should definitely just keep in contact. It was great connecting with the rest of you guys, by the way. It was a great forum. Thank you, Hugo, for having this tonight.
No, thank you. Thank you, everyone. I was super excited to have all of you. I mean, if there's anybody in this market who understands and knows lending, it's all of you today. So I was just so thrilled to have you all together tonight. So thank you very much for making time tonight. I greatly appreciate it. And friends, thank you for joining. And this is a time to, as everyone says, sit back, learn, sharpen your saw, and obviously stay safe. So thank you everyone for joining, and then we'll send out the replay for those who would like to see these again. So thank you, Juan, thank you, Vince, thank you, Brandon, thank you, Nancy, for joining tonight.
Thank you. Thank you, everybody. Stay safe, stay healthy, and let's we'll all get through this together.
Perfect. Thank you, everyone. Bye-bye.
Bye-bye.
Bye.